Okay, guys, thank you guys for being here. Really excited to talk with you and help you all navigate some of your personal finances and your business finances. If you're a solopreneur like me, I've had the pleasure of knowing Kristine now for a couple of years, and she's been super helpful in helping me understand my finances. And recently, she's been really geeking out on the Profit First framework. So if you're interested in asking some questions around Profit First, if you've heard about it, I'm sure Kristine will bring it up in the presentation here today. But I am here as your host. My name is Jay, and co-hosting this with Kristine on behalf of Freelancing School. Kristine's business is Avant TaxWorks, which provides individual and business tax preparation and accounting services with the personalization that software packages cannot do. And I can attest to that. So excited to have Kristine here. If you have questions all along the way, feel free to put them into the chat. I will bring them up wherever is most convenient. As Kristine goes through this presentation, I do want it to be a little bit of a real-time conversation. So if you have questions in real time, put them in the chat. I will pop in and interrupt Kristine when I feel like something needs a little bit more explanation or when a question comes in. So all throughout this, feel free to put your questions into the chat. We're planning to go through about 30 minutes of planned presentation here that Kristine has, but then we really want to get into some of your situations and what we can do to help you. So also welcome, Rosie, I believe. Great to have you here as well. I'm going to hand it over to you, Kristine. You can go ahead and share your screen and kick things off, and I'll mute myself and pop back in whenever it's most useful.
All right, sounds great. Thank you, Jay. Thanks for everyone for taking time out of your day. I'm so glad that you're thinking about this. We want to take the stress away of tax time, and to do that, we need to start thinking about it now. So I just wanted to go through what we're going to be chatting about today. We're going to go through your accounting toolkit, the who, what, when, where, and why of filing taxes, calculating and paying your estimated taxes, the magic of write-offs and what they are, and the common mistakes that you won't make. So to start with the accounting toolkit, the first thing I want to discuss is banking. It is so important to keep your personal and business bank accounts and your credit cards separate, along with your business payment processor, especially if you are an LLC. You don't want to pierce the corporate veil. So that protection that LLC is providing you, it needs to be separate. So if they look at your business, they will not look at your personal finances either. If you're not an LLC and you're just maybe operating under your name, you can always get an EIN, which is like a social security number for your business, and it's free. So that way you can open up these business bank accounts. So two banks that I really like are Chase. I love Chase for the ease. Their app is super easy. One downfall with them is you do have to maintain a minimum balance, which is typically $1,500 to avoid any fees. A new bank that's on the scene that I'm really enjoying is Relay Financial. They allow you to open up to 20 bank accounts with zero minimums to avoid fees. And I like that, as Jay mentioned, Profit First. So in Profit First, we utilize 5 different bank accounts. They are great from a technology and a collaboration standpoint. However, if you needed to deposit cash or if you handle a lot of cash, they wouldn't be a right fit for you.
I'm going to jump in here because I already have a question.
Yeah.
I also use Chase because I like that they basically created one dashboard for me for both my business accounts and my personal accounts, which is super nice just to be transferring things back and forth. But I have an Ally account, which I think you have some experience with, and the benefits you're describing with Relay Financial sound similar to Ally. Do you have any points of differentiation between the two?
I'm actually not familiar with Ally. I don't have any clients on that. Now with Relay Financial, they're taking it from a standpoint of if you're collaborating with like an accountant, there's a lot of different permission levels and things that we can see more than a typical bank usually allows you to do. And they integrate automatically with like Intuit, QuickBooks, and Xero.
Cool. Headline here being keep your personal and business accounts separate.
Yes, so important. So that leads us into bookkeeping. So we have our separate bank accounts, which is also going to make the bookkeeping so much easier. Spreadsheets work. I love spreadsheets. I love Excel. But cloud-based software can save you a lot of time. it automatically connects to those bank feeds, or the banking, which they call bank feeds, to allow you to categorize those expenses. Another thing is to keep those receipts. You need those to substantiate your expenses. And then minding the balance sheet. So what I mean by this is, as entrepreneurs or solopreneurs, typically you're just looking at your balance or your profit and loss, want to know what your net income is. That's what you're utilizing to create your tax return or what you're handing to your tax accountant. But the balance sheet's really important to see your liabilities. So if you have a credit card, or maybe you got the PPP loan, what those outstanding liabilities are, if you have money that's due to you. And another thing that keeps track are those owner's draws that you're going to be taking. So how much money are you taking out of the business to pay yourself? That's going to be on the balance sheet. So two softwares that are really popular is QBO and Xero. We are a QBO firm, but Xero works great as well. And like I said, spreadsheets can just be as good as long as you're keeping up with it and being consistent and accurate. How you get the information, there's a lot of different ways to do that.
QBO is QuickBooks Online.
Correct. Thank you.
And does that include their self-employed product, or is that like the full stack like QuickBooks that you recommend?
I'm so glad you asked. So I am not a fan of self-employed at all. So self-employed, you can, first of all, you can never upgrade from self-employed. So once you're in there, you can never move on to any of their other packages or their other offerings. And there is no like reconciliation. I don't even think there's a balance sheet. So it was kind of more for those people, maybe they have like a side hustle that they're not really operating maybe as a business like they should be. That's more for who self-employed is geared towards.
And that's why I asked, because I don't think I've seen, I use it, but I don't think I've ever seen a balance sheet. And I was like, oh, that's kind of nice. That would be nice. Like I can see within one of my investing softwares that it has basically a balance sheet for me there. And I'm always looking at it like, oh, this is really nice. That's showing me my liabilities versus my cash. Why doesn't my accounting software do that?
Oh,
So
yes.
maybe I should upgrade too.
It's time to upgrade. Yeah. So yeah, and unfortunately like that, it's not an easy transition. You kind of have to start over. So I always say start at the lowest one. They're usually running specials, or you can work with a pro advisor to get you discounts. So there's a lot of ways to save on the software too. So next one is mileage. So keeping track of mileage. Again, with that, you just need to have the date, the starting point, the ending point, the purpose of the trip, and then of course the actual mileage amount. And you can do that in a spreadsheet very easily. If you do have QuickBooks Online, there is an app that's connected that you can track the mileage. The other app that's really popular is Mile IQ. So typically these apps, they'll basically just follow your car, and you go in and you say if the trip was for personal or for business. If most of your trips are for personal, then I recommend just kind of keeping track only when you're doing a business mileage. And lastly is integration. So if you're going to utilize a cloud-based software program, I love integrations. It provides more, richer data, faster. I just say proceed with caution. Even with the bookkeeping software, you're trying to educate yourself on bookkeeping as well as the software. And same thing with the integrations, making sure they're being hooked up correctly and not kind of making a mess of your books. But when they're hooked up and you're utilizing them, they are great to have. So I like to hook up like payment processors. So if you're using PayPal or Stripe, you can get some richer data doing that. Honeybook really does a great job with syncing client information. If you have clients that have like a payment program, you'll actually see how much of outstanding payments you have when you're looking at that balance sheet. And Dubsado does a similar thing as Honeybook with their integration.
So if I can kind of recap this slide and the most important parts here.
Mm-hmm.
Have a separate bank account for your business. It's much easier to track your finances that way. Have some sort of bookkeeping software like QuickBooks or Xero so that you can reconcile that bank account. Track your mileage, because that's a big point of expense that I was missing for the first 2 years when I was freelancing. And I did it last year and thought, my gosh, this was so easy to do. Why didn't I do this for 2 years? And integrations being like, if you are processing payments or invoices in another software, connect that to your QuickBooks or your Xero, whatever your bookkeeping software is.
Yep, you got it. All right, so we have our accounting toolkit. So we have our information. So now we got to start thinking about the tax returns. So who's filing? Anyone that operates a business, meaning that if you materially participate and there's a profit motive. So you could be a sole proprietorship, a single member LLC, a partnership, multi-member LLC, an S corporation, or a C corporation. And even if you just, I get a lot, I'll ask somebody like, oh, do you have a small business? They're like, no, I'm a freelancer. Okay, but we need to kind of operate and get in the mindset of, hey, we're a business, you know, even if it's just the business of ourselves, and we need to operate as one as well. So the purpose of this, we're going to be talking about sole proprietorships and single member LLCs. So what are we filing? We are filing our federal individual income tax return with a Schedule C. So the Schedule C is all our business income and expenses. Then there's additional forms and worksheets that go along with that. Then we're also going to be filing our state and local income tax returns. Just to let you know, there's also other possible tax obligations, you know, sales tax, franchise tax, property tax, excise tax. So depending on your state and locality, you may have some of these additional tax obligations that you need to check in with.
I'm going to say something obvious because it took me a couple years to learn. I think maybe somebody listening might benefit from this too. I didn't realize, like in the beginning when I was trying to do my own taxes and I was screwing around with like, what are those like quick, what's Intuit's tax?
TurboTax.
TurboTax. When I was screwing around with like TurboTax, I didn't realize that the questions it was asking me was basically so it could fill out a Schedule C for me. Like at the end of the day, it all files the information you're putting into software like that into a Schedule C, which you can do yourself if you know how it works, or that's what your accountant is doing based on the numbers you provide. I don't know why it took me so long to realize that. I thought that like it was its own interface, it was its own reporting system, but no, the Schedule C is what gets filed.
Yeah. And that's where it can be great, especially if you have some knowledge at the end that you can kind of review what it does. But sometimes if you answer just one question incorrectly, it's kind of going through that tree of other questions. And that's where we kind of see some mistakes come up. Another important thing, if you have a state that has local taxes, a lot of times TurboTax does not inform you that you need to be filing local taxes for your business. So you always want to check that as well, because I see that happen a lot. And we're in Ohio and we have tons of local taxes. All right, so when are we going to file? So we're talking about that individual income tax return on a normal year, not 2020. It is April 15th. And then you can extend, and that gives you until October 15th to file. But as a reminder, this isn't an extension to pay the taxes, only an extension to file the taxes. So you need to have an estimate of what's going to be due, and that payment needs to be made with your extension by the April 15th to avoid any additional penalties or interest.
I'm going to double click on that too, because that's something I didn't realize. Like I thought extension meant, oh, I have until October 15th to pay this. And that's not true. It's filing like your final figures for the year. If you extend to October 15th and you don't actually pay, what is possible to have happen?
Penalties and interest will accrue. So failure to pay penalty will be assessed.
Gross.
Yeah. And that's what we're avoiding here. So where are we filing these tax returns? So we're definitely filing with the IRS, but we need to consider the following for your state and local taxes. And that's, where is your business registered? Where is your business conducted? And also, what is your residence? So there is a lot of different rules for different states, different localities. So it's important to either review these individually and see what your filing obligations may be, or of course to work with a tax advisor, making sure that you're providing this information to them so they can make the determination if there needs to be additional states or local taxes to be filed.
If I'm in Columbus, Ohio, which I am, and my business is registered in Columbus, Ohio, but I do a lot of online work. Let's say I do only online work. Am I still needing to worry about local taxes?
You do. So your business is operating out of Columbus, so you'd have to pay those to Columbus. All right, and the why. Pretty self-explanatory. We're avoiding penalties and interest. But there's also use for income validation for personal loan purposes. So if you're going to go mortgage your home, and if the income that you have is primarily self-employment, we want to be able to show this on a Schedule C. And then we're also paying into Social Security and Medicare because we're paying that self-employment tax, which we'll get to a little bit. So like I said, with these returns, it's part of your individual income tax return, but there's actually two taxes that are being assessed on this income from your business. First, it's the self-employment tax. So when you're employed, you pay half of Medicare and Social Security. Well, now that you're self-employed, you get to pay both sides of it. So now you're paying 15.3%. And then that's in addition of your individual income tax rate. So we're going to try to see how can we reduce this, right? So we want to bring in money, we want to be profitable, but we don't want to lose out on any expenses, because these write-offs, they are these expenses that you're using regularly and exclusively for business, which then reduces your taxable income. So I just took some very arbitrary numbers over here for someone who is single, no dependents, and let's say they make $100,000 and they didn't keep track of their expenses. This is a breakdown of how much they'd be paying in income tax, which is under 10. Self-employment tax is just under 15, for a combination of just under $25,000 in tax only on $100,000. So with expenses, and I put it down to $70,000, you can see how it drops now our income tax, our self-employment tax, for a total tax of about $15,000. So we dropped off about a third, which is pretty typical. You know, if we reduced the net, the gross income by 30,000, we saved $10,000 in taxes.
I want to stay on here because I think this is a really useful graphic, and I want to make this really, really clear. So this graph is for somebody who is earning $100,000, and that's what they know. They know I grossed $100,000 this year.
Yep.
Income tax, you said, is just below $10,000. How did you figure that out?
I have software
okay.
that figures that out. But I mean, it's about that 10, we're at about the 10% effective rate. So that's about 10%.
Okay. And self-employment tax is what you're just talking about, this like 15.3%. Okay. So why is that? How is that not 15, a little bit more than 15,000? Is it because it's less the income tax?
Because we also take out, you get a credit for the self-employment tax that you're going to be paying. This also included the standard deduction, so it kind of lowered it. So it hovers.
Got it. So the net result of this, for someone making $100,000, their total taxable income is, the $70,000, that total at the far right, is that total taxable income, or is that after income is taxed?
Taxable income. So the 100,000 is just like, hey, we grossed 100,000 and we didn't take any expenses. This is just what we, and then we could take it as we actually took about $30,000 in expenses, and this is how it's reducing our taxes.
This makes some sense, because I've heard some recommendations of basically like earmarking 30% of your income as going to be taxed. How does that track with you? Obviously, like when you do the final math and you do your return, it's not going to be exactly 30%, but is that a figure that you use as well?
It's a really safe figure. I think sometimes it can be a little much, but it's a safe figure.
Cool.
All right. So we know how important these write-offs are. We can see how it's reducing our taxable income, making us pay less taxes. So what are we tracking? What are these write-offs that we can take? So the first one I want to discuss is like operating expenses. So examples of that are advertising, office supplies, travel, meals, rent. If you have subcontractors, it's anything that is keeping the business running. Obviously nothing too luxurious, but what we need to do for the day-to-day operations. It's also important when it comes to meals and entertainment to really track that information, especially meals are only 50% deductible on your tax return, and you should keep track of who you had the business meal with and the purpose. Entertainment, such as, let's say you have a prospective client and you take them to a show, that is actually not deductible currently. So you want to keep track of these things, but notate the purpose. And so you can make that assessment, or your tax advisor can make that assessment during preparing your returns on how much we get to deduct of the meals and entertainment. Travel is another one that I like to put a little asterisk by. So if you are traveling, but maybe it's a little mix of business and pleasure, there may need to be some additional calculations that need to be done. So we're only calculating the business portion of travel. The next one is capital assets. So capital assets are when you're making a purchase for something that's going to be used in your business for longer than 1 year. They should be depreciated. There's a lot of different things that go into depreciation. So to make it easy, there is an election that you can make, and it's called the de minimis safe harbor election. And this allows you to automatically expense anything that's under $2,500. And that would be even just like a line item in an invoice. So let's say you're a photographer and you bought a new camera and that was $2,300, and you bought some lenses and let's say those were $500. So the whole invoice was $2,800, but since each item was underneath that $2,500 threshold mark, you can expense both. The only thing that I like to keep in mind with that though is maybe you're just starting out, so you're buying all of these assets. Yes, it can be nice to show a big loss in the first year. It's reducing that taxable income, but we're going to assume you're going to be real profitable the next few years. And maybe your primarily services and your expenses are really low. It might be nice to have that depreciation kind of spread out. And that depreciation is just taking an expense for that camera per se for the next like 5 years. So there is some kind of planning that can be helpful when dealing with capital assets and depreciation.
Something I want to add here when you're talking about these operating expenses, this is why a bookkeeping software like QuickBooks is so useful, because nobody wants to get to tax season after never paying much attention to their transactions and then having to classify in like through history retroactively, oh, this was a meal I had with this client for this reason. It's so hard to do. Even if you have like a flawless calendar that talks about that stuff, nobody wants to do that exercise once a year. Doing it once a month or even weekly or bi-weekly is so much easier to go in and say, yep, I remember this meal. It was last week. This is why we did it. Stuff like that.
Yep, absolutely. And QuickBooks is great too, because you can attach receipts. So it's a lot easier just to like snap a picture real quick of that receipt and attach it into QuickBooks instead of maybe piling up the receipts. That way it's always there. It's a great way to have an audit set proof of books. If you have receipts attached to properly categorized expenses, it's reconciled, you are golden.
Let me ask you something about that then too.
Yeah.
I've been bad historically about keeping receipts because I think, well, the transactions in QuickBooks, like I can speak to what that is. The real reason to keep those things is in case you get audited, it's easy to go through and really point to all these things.
Right.
Or
yeah. You're substantiating what it was for.
It's not something that you file that year necessarily. It's just protecting yourself because audits can go back multiple years.
Right. Correct. Cool. The next one is home office. So a home office must be used regularly and exclusively for business. But I always like tell people, when we're speaking about home office, it doesn't have to be necessarily a dedicated room. So even if you just have like a dedicated space in the corner and it's your desk and you can imagine like an imaginary wall, then that can be a home office as long as you're using it regularly and exclusively. And there's two ways to calculate the home office expense. One is the actual method. So that's when you're taking the square footage of your office and the square footage of your entire home and getting a percent. So let's say it's 5%. And then you get to take expenses such as your utilities. If you're a renter, you get to do rent. If you're a homeowner, it's property tax and interest, like mortgage interest. And then you also depreciate your home if you're a homeowner. That one can get a little tricky, especially if you go to sell. The other option is the safe harbor method, and that is $5 per square foot. And that's all you have to do. If you're a renter, I really suggest typically the actual method.
Because that's the higher expense usually.
Yeah, so you get to expense part of your rent. You don't have to worry about the depreciation. If you have a security system, if you have a cleaner, there's a lot of different things that you can utilize.
And you would recommend like the safe harbor quick math method as something to do if otherwise you're not going to do the calculation, or there are times when it actually is more beneficial from a pure numbers perspective?
A lot of times I do see the actual method being more beneficial, even there, not to go down the road, but when you go sell your home, you have to recapture depreciation, which can lead to some additional tax during the time of selling. But typically the amount of taxes you've saved along the way is more beneficial in the long run.
So I would say, just for people watching, the takeaway here is know how many square feet your home office is before tax time, so you can share that with your accountant. But is there anything else that are there any like gotchas where you need to not be doing this in your home office space to be able to like make sure it's usable for this line item?
I think just making sure it's regularly and exclusive. You can even have, like, maybe you do co-working once in a while, or maybe you have an office you meet clients, but as long as you're doing like managerial activities at this home office, you can have both. So if I'm doing some client work, or if I do my scheduling and my billing at my home office, even though I may go meet a client at a co-working space, I can still deduct the home office, but it is a place that I'm using only for business, all the equipment, things like that. Our business. So the next one is mileage. And this is kind of going back to the home office. If we can establish a home office, it can be really important when we're talking about mileage, because we need to see if it's considered a commute or if it's a business expense. So if you do not have a home office established and you go to a client or you go to the office, that's a commute and you do not get to track that mileage. However, if you have that home office, we can now take mileage anytime you leave your house for business purposes. So other than tracking it, like we talked about with your accounting toolkit, I also recommend doing an annual odometer reading. So just like take a quick pic with your phone of your odometer, because that gets us your beginning and ending mileage for the entire year, which we use for calculating. And you can calculate mileage two ways, one being actual costs. This includes everything to keep your vehicle operational, or standard mileage. Typically, we do standard mileage. The actual is just a lot to keep track of, and I don't ever see it really happening. The standard mileage rate, as JD alluded to earlier, is such a great expense. So to keep track of that, the standard can, help you get that taxable income down.
I think last year the standard mileage rate was like 58 cents per mile.
Mm-hmm. Yeah.
And you can very easily rack up like hundreds of miles from some of these meetings, and that's an awesome expense. But you can't double dip, right? When you're talking about actual, like, you couldn't take standard mileage plus your cost for gas, or can you?
You cannot. Nope. The next one is the cell phone. Just because we typically now use our cell phone for business as well, you want to take the business percentage of your personal cell phone as an expense. So you want to take your portion of the bill. So if you're on a plane with somebody else, you just want to take your portion of it and then put a business percentage against that. So think about how you're utilizing your phone. Maybe you're posting on social media, you're responding to emails, clients still may call that personal cell phone number, and assign a business percentage. I just say never go over 80%. And home office, mileage, cell phone, these three things are these are my favorite expenses, because you're already paying for these things personally. So now we can use it for our business and reduce our taxable income. So we're going to jump to calculating and paying our estimated taxes. So there's two ways to do this. The first version is what we call safe harbor. And it's probably what you guys would be most familiar with, whether you're going through TurboTax or maybe working with a tax accountant, because it uses the previous year's tax obligation and makes you pay in either 100 or 110%, and it divides it by 4. So that's when you get those little vouchers that you have to send in. So that just allows you not to be subject to an underpayment penalty as long as you make those timely estimated payments. The actual projection is more, checking in with somebody and using the projected business income, as well as any changes to your personal tax situation. So if you got married or you moved or you had a child, maybe the business is booming, maybe it's not doing so well. All of these would fluctuate what we're going to calculate your estimated taxes to be. So when doing the actual projections, we're trying to get, as close to zero, maybe a little bit of a refund as possible. Safe harbor, you could be severely underpaid and have a big bill, or maybe you get too large of a refund. You could have kept that money in your pocket throughout the year.
In case someone's not familiar, what are estimated taxes?
Yeah. So the IRS and any other taxing authority, it is a pay as you go system. So that's why they're taking, if you're on a W-2, they're taking money out. And we have to do the same thing for our business. We should be paying our taxes as we go. And they ask us to do that by submitting quarterly estimated tax payments.
So as a business owner, once per quarter, every 3 months, you should be sending both federal, state, and maybe local taxes estimates of what you think, for your return. If you are this person earning $100,000 and you think that's about going to be your year total, you should have an estimate that you're paying quarterly towards that total, so that you don't have to pay all your taxes at the end of the year. Which some people, when they're just getting into freelancing or self-employment, they don't realize that, and they file their return, they realize, oh, I haven't paid taxes all year, I have to pay all of this, and it becomes a really big headache. So paying quarterly taxes, not only is it like what you need to do legally, it also protects you from having a really nasty bill and surprise at tax time.
Yeah, absolutely. I hate surprises. So I'm glad we're doing this so there's no surprises. But I'm going to correct you, Jay, because it does get tricky. It's not every 3 months. So here's the estimated due dates.
No.
Because they're April 15th, June 15th, September 15th, and January 15th. And like Jay said, not wanting to have that huge tax bill at the end of the year is so important, because as you can see, the same day we're filing taxes for last year, they want our Q1 estimated tax payment the same day. So making sure we're planning ahead so we're not getting, double whammy basically with these surprises on the 15th.
What if I didn't know this is a thing, and we're sitting here, it's August as we're recording this, and I didn't know that Q1, Q2 taxes were a thing? Am I going to jail?
You're not going to jail. I would make up what you can as soon as possible. It really comes down to if you're going to be subject to any penalties, and then there's different ways to calculate that potential penalty and the failure to make those timely payments. But you're not going to jail. I would just try to rectify it as soon as possible. All right, so lastly, we're going to kind of overview and then also make sure that you don't make any of these mistakes that I see very common. And because you're here, you're wanting not to be disorganized, which is great, because it really does just cause so much stress. It causes the uncertainty. We don't know how our business is doing. We can't look at our business and its profitability. We can't look at taxes and what we think are going to happen. So it's really important to know how your business is performing throughout the year. I hate to see when people are like, during tax time, like, oh yeah, I'll give you your numbers in like a week or two. I have to compile everything. Like that is just so stressful and trying to dig deep and remember everything. So, don't be disorganized, not taking deductions. So you may not know all of the ins and outs, and that's something you can continue to educate yourself on or work with a tax advisor. But whatever you do, don't be afraid to take these deductions. I hear that all the time with like the home office expense. Like if you rightfully can take home office, it's not a red flag. If you can substantiate this home office, do not be afraid to take it. The key is to document it. Just as we were talking about with estimated taxes, not paying your taxes. So be proactive in paying them with the estimated tax payments, because I do unfortunately see this happen, is especially for new business owners, they were unaware, they didn't think about it. We have this huge tax bill. Maybe they don't have the cash set aside that Q1 payments due. And it just becomes a snowball effect that we're just trying to get ahead of and get caught up on. So be proactive as you can.
Obviously, everybody's situation is different, so you won't have perfect advice on this. And also, this is not advice. What is the process like, how does the IRS determine when they're going to do an audit or why they may audit? Not on an individual level, but like, do they just kind of do it at random sometimes? Do they have certain things that are red flags? Do you have any insight?
Yeah, it's a lot of algorithms. So, one of the things they ask you, I'm sure with TurboTax, they tell you, what is your NAICS code? So what type of business are you? All right, I am an accounting business. Okay, well, maybe for accounting, my meals and entertainment are like crazy. Why is that? So maybe the algorithm on that would flag me. But a lot of it is just random selection, unfortunately. But there's also algorithms that we're working between.
Yeah.
But there's no need to worry as long as you can substantiate it. Other common mistakes that I see from like a bookkeeping side is recording tax payments as expenses. So as a single member LLC or a sole proprietor, when you're paying your income taxes, whether they're the estimates, year end, those are not business expenses, they are personal expenses. There are other business taxes that are allowable expenses, such as the sales tax, the franchise and excise tax, but your personal income tax is not a business expense. Another thing is incorrectly paying yourself. So as a sole proprietor in a single member LLC, you do not put yourself on payroll unless you've been elected to be taxed as an S Corp. You're also not a subcontractor of your business. So you cannot make yourself an expense on your books. You're taking draws like we talked about, and those draws are not expenses and they're recorded on the balance sheet. And last one is becoming an S Corp because Google said. This is such popular advice, whether you have an attorney, maybe forming your LLC, another business, you Googled some things on how to save on taxes, or like S Corp, but this is not for everyone. And this is something I would say you should definitely consult with a tax advisor with before you make the election. There's a lot you have to consider, such as taking reasonable compensation, as well as it may actually not be beneficial to your own personal tax situation. So there's a lot of projections and things that we do to make sure it makes sense, because it is a lot of work just to put yourself on payroll too.
Just to give some context to folks, this wasn't Kristine's advice. This is advice that someone else gave me at one time. But she said, I probably shouldn't think about an S Corp unless I'm clearing like $150,000 annually in gross, which is a long way to go for someone getting started. And I'm sure that's like its own calculation. It's very subjective to how you might do it. But the point is, like, it's a high number to be financially worthwhile at this point to be your own employee in an S Corp.
That's correct. And there was, probably a few years ago before the Tax Cuts and Jobs Act, we were paying $75,000. And so that's drastically changed with the new small business income deduction. And that's why you're seeing it higher. And it's going to be more scrutinized too, because there's like a sweet spot that you can kind of take both. And so they're really going to be scrutinizing that reasonable compensation. That's all I have, guys. Here's my contact information. You can follow, online. If you have questions, of course, we're gonna go through questions here. I'll throw it over to Jay. But if they pop up after this, you can feel free to either email me or give me a ring.
Do you want to start with a really hard question?
Yeah, let's get it out of the way.
What do you know? And this is all like evolving in real time right now. What do you know about, I'm self-employed, and say I got a PPP loan from this year's stuff. How should I be filing that? Because you brought up that it's not an expense. It's not payroll, even though they made this explicitly available to people who are single member LLCs. And you have to prove it as paying yourself, but it's a draw. So what are you thinking as far as bookkeeping goes, how we should be thinking about that?
Yeah, so for current, and the advice, it's always changing with the PPP loan, but currently what they're doing is they're looking at your 2019 net income, because if you recall, when you applied for the PPP loan, they gave you 2.5 months of your net income. So for self-employed individuals, they are looking now at 8 weeks of your net income. So you would take your net income, divide it by 52, times that by 8, and then that would be the amount that's going to be automatically forgiven. So there's nothing that you really need to show as a self-employed person. You would just that's going to be that. There is a rumor that they're just going to automatically forgive any PPP loan under 150,000. And that's what I'm hoping for.
And it's not something that you should be thinking about as business income either.
No, not necessarily. But currently, the way it stands is you're unable to take the expense. So if for the PPP loan, you don't have to worry about it on the payroll side, like we talked about. But if you're going, let's say there's still additional PPP loan that you want forgiven, and you're going to utilize rent for that. Well, that rent is no longer going to be expensed either. We're still waiting for more guidance on that, but that's currently how it's written. So although it's not income, you're not able to take that expense. So it's kind of the same.
Something that I began learning from you, and we just got a question from Brittany. So actually, let's start with that. When should a new freelancing business start a bank account or get an EIN? Is her question.
As soon as possible. As soon as possible.
Totally agree.
And I'll be honest. So I actually started freelancing as an accountant. Like I went to different accounting firms as a freelancer for accounting and was kind of tiptoeing my way towards this. And even when I first started, I did like a DBA and didn't get an EIN. And it was much more of a pain for me to go back and figure and redo it cost me more money to file this paperwork. So as soon as possible, especially as a freelancer, getting the EIN, because you're going to get requests to turn in a W-9 so they can 1099 you. So you don't want your social security number floating around either. So you'd want to get that EIN.
That's the exact same advice that I give. So I'm glad you're validating that, because literally the first thing I did when I quit my job and started was like, okay, let me file an LLC so I can get an EIN, so I can get a bank account, because it's so useful to keep these things separate. So easy then to reconcile later, like what was a business expense, what wasn't. And like you said, I hated the idea of having my social security number just floating around in all these W-9s.
Yeah.
Rosie asks, and Rosie, tell me if I'm not pronouncing your full name. Is it Rosil? I'm not sure. She says, my fiance is interviewing for a company outside of the US and we can potentially be moving abroad. Do you have any tips on how to prepare for tax season and dealing with financials earned in the US while living abroad? Big one.
That's a big one. And international taxation is not my specialty, but I do have great resources and colleagues. And that if you want to shoot me an email or whatever, I can definitely connect you with someone who does more in the international space.
Razil, I'm sorry. That should have been obvious. I should have figured that out.
You sounded it out.
and Adam says he lived in the UK for 9 years. So find an accountant in the country you're moving to who can help. Kristine, I wanted to ask you something that I've learned from you partially and look forward to learning more about. That's been really helpful for me this year. I've been putting my tax payments away in a separate bank account so I can't touch them, which is like along the lines of profit first. So for people who aren't familiar with a profit first framework, can you give us kind of a high level of what the benefit of profit first accounting is?
Yeah. So profit first is, I don't know if you're familiar with the old financial envelope system, but it's basically the envelope system for your business utilizing multiple bank accounts. So we get to save for taxes. We get to pay ourselves. We get to have operating expenses. And then we also get to keep the profit from our business. And we also have an income account. So basically what it does, it gives us allocations, or these target allocations, which are percentages that we utilize against our income. So if we get paid $10,000, typically we should be paying ourselves 50% of that. And we're going to move $5,000 to this owner's comp account. So it's a great way, as Jay said, to look at your bank and see how your money is distributed, and to feel comfortable knowing that your taxes are saved up and you have money in your owner's comp account and you're going to be paying yourself in the future.
Yeah, really nice. Basically, instead of just looking at your balance at any given time and wondering like, do I have enough money to pay myself? Or like, should I just pull this out and rent now? Every month, you're taking money out of what you earn that month, allocating it towards things like taxes. And here's how much I want to be earning in owner's comp. And here's how much I need to operate my business. Such a smart system. What would people need to do if they want to learn more about that or get started doing something like that?
They could start by reading the book. It's Mike McCowitz in Profit First, just launching a new Facebook group, which is called Empowered in Numbers. And we'll be discussing that further as well. I love this system for entrepreneurs. Even as an accountant, I can run ratios, look at my balance sheet, my profit and loss. I can do all those things, but just opening up all my bank accounts and seeing exactly how my money is distributed is such an amazing feeling of just feeling empowered and knowing how your business is doing and where it's going. I was like hoarding money. Like I was afraid to pay myself. I would just keep money in the business because I was scared to take it out. So I am now paying myself, twice a month, the same salary, and being able to look at that account and say, hey, I've got the next 3 months covered or whatever too, is a really great feeling.
We have a couple minutes here. Anybody else have any questions of either clarification of what we covered or didn't cover here? Anything else that's particular to your situation? We have a couple minutes, so let's take advantage of it. And while we're doing that, I'm pulling up Kristine's Facebook group, which is literally launching today.
Yeah.
Literally launching today. So if you have more questions, this is a really great place to go because you're going to have access to Kristine and some of these questions that you have. I'll put that in the chat. Brittany, the name is called Profit First. And if you're like me, you're going to read through the first chapter or so and be like, I love this. And you're going to get to the chapter where it asks you to, okay, now stop reading and create multiple bank accounts to do this. And you're going to feel a little bit of friction. You're going to get a little bit stuck. So working with somebody who's gone through the system and worked through some of those hurdles can be really, really beneficial. Here is the Facebook group in the chat. It's facebook.com/groups/empowered-in-numbers. So yeah, I just joined that group this morning. I'm going to abuse it and ask Kristine questions about my numbers and my accounting. Obviously, we'll have a replay of this that we'll probably put in that group, and I'll send out to everyone else who registered for this as well. But Kristine, we're out of questions, so I'll give people 30 more seconds to add anything they'd like in the chat, and if not, we'll give you 10 minutes back into your day and move along.
Yeah, thank you guys so much for taking the time, and hopefully this helps. So less stress, less mess, right? Not hot mess express come tax time. That's my goal.
Totally. Everything you can do to keep track of this as you go through the year. Like I do this monthly. The other thing about Profit First that I liked is for me to do the allocations, it kind of forces me to do my monthly reconciliation. And I'm not perfect at the system yet, as you know, but at least it's pushing me to do monthly calculations and reconciliations, which makes it a lot easier when tax time comes. It's as soon as the year is over, I start talking to an accountant and I say, please help me file this ASAP because I want to return. I feel like I'm going to get actual money back on the return because I'm saving.
Yeah.
And all right, everybody.
Things, the monthly allocations with Profit First or those the monthly reconciliations. It just gets you so, and how your business is doing as well. So it's great.
All right, everybody. Thanks for joining. Thank you, Kristine, for putting time into the presentation and going through all of it. Super, super helpful. If you guys have any questions for Kristine, go to the Empowered in Numbers Facebook group. You can also go to AvantTaxWorks.com and get a hold of her there. My name is Jay. You can find me at jklaus.com or at freelancing.school. And I guess I'll be talking to you next time, Kristine.
Awesome. Thanks, everyone. Thanks, Jay.